That's what the market said to the Federal Reserve. This attempt to finally normalize was stopped dead in its tracks. We always intervene now. We will never stop. We can't stop. The moment we try to be non-accommodative, everything blows up in our faces. So for example, right now, I don't like the long side here. Made no secret about it. At the same time, I recognize the factors that are at play that say, yes, we can get this crazy blow-off move. Most people know me on Twitter under NorthmanTrader, the website I operate, looking specifically at market direction. We analyze market from a technical perspective, as well as the macroeconomic perspective. That includes politics, central banks, what's happening with the economy, and all that good stuff. Prior to trading, many years ago, for 20 years, I actually was in the corporate world. And this is probably where I picked up all my analytical skills, if you will, sharpened the skills. Mostly corporate finance, but also operations management. Did a lot of international corporate development in Europe, Asia, South America. And we looked at valuation of companies, obviously the build out of companies. So I had always had a good knack for analyzing business plans. Well, it's very simple. We've had basically three drivers. The first, the most obvious driver was central bank capitulation. Obviously, we came from a period where the Federal Reserve claimed they were on autopilot and the balance sheet roll-off. They were projecting rate hikes for 2019 and obviously caved on every single aspect of that. And it brings back the same spiel, basically, that we've seen in equity markets for the past 10 years. You know, you see a little bit of trouble in the equity markets. In this case, maybe a bit more serious trouble because we had a 20% correction. And then immediately central banks back off or intervene. And in this case, they backed off, completely reversed policy, and that had a dramatic effect on expectations, on rates, and of course, getting back into the regular mode of, okay, central banks have our backs, and therefore we rally back into equity markets. It's been really a well-documented script that we've had in markets now since the financial crisis, and hence every corrective activity doesn't last very long. But the second aspect, of course, is also the amazing amount of jawboning that we've seen on the side of the administration with regards to dangling a China deal, right? Because a lot of the growth slowdown globally is now blamed on trade wars, if you will. And so there's hope that a China trade deal will miraculously turn the growth curve around. And we've seen it. I mean, you've seen me on, many of you may have seen me on Twitter documenting it. Others do as well. You see constant headline coming out, or we had a phone call tonight, or there's going to be a phone call tomorrow. And the algos react to that, or they have been reacting for a long time in this first quarter. And then, of course, the third aspect is buybacks, record buybacks. We had $270 billion in buybacks in the first quarter. Mind you, we had record buybacks last year as well, and that did not stop selling at the end of the day. But when you see, again, an environment where you have low volume being predominant, marking the landscape, buybacks obviously make a difference because they maintain a steady bid in the market. First of all, there's technical factors that I'm watching. And what I see in the rally specifically now is it's kind of repeating the pattern that we've seen last summer, actually. And what you see is a lot of gap ups, tight intraday price ranges, these gaps not getting filled, volume declining. And one of the patterns I watch is a rising wedge. Now, these wedge patterns can last for months. Last year, it lasted for months. It actually was an aggressive wedge pattern into the January 2018 highs. So what happens is price compresses ever more. Volatility compresses, and at some point, you get a trigger and the pattern breaks, and then you have that volatility explosion. Specifically, we see it on the NASDAQ, and it keeps rising. And what I said last summer, too, is that as long as these things keep rising, they can stretch the imagination, if you will. And I think this is probably the biggest challenge for traders, too, frankly, also for me. You see something, and you have to have the patience to wait for it to happen. But then, of course, it can happen so fast, then you're either in the move or you're not. That's one of the big challenges. So from that perspective, as long as the pattern structured holds, it can keep going. When it breaks, I think that's when we ultimately have the first challenge for this market in 2019. Because so far, this rally, and this is probably, to your point, the most hated rally, it does not correct in any shape or form. This has been completely uncorrected from day one. We had this initial blip in early January when Apple announced the earnings warning, and then Jay Powell came in with his flexibility on the balance sheet, and since then it's been nothing but up, right? And NASDAQ had one down week in all of 2019. And that's a concern. You're on a trajectory that's not sustainable for the rest of the year. So at some point, that pattern will get tested. The question is, what happens then, right? I mean, as long as markets can retest some moving averages and stay above them in some key levels, then we can gather more energies, right? You have currently a classic V pattern. You can see maybe some sort of cup and handle, if you will, and then off you go to massive new highs. That's a possibility. Unless you break particular levels, then of course you can make the case we're still in the bear market rally, which sounds absurd at this point because we're so close to new all-time highs. But that's a really important consideration as well. And that's why I'd like to tell myself and our clients, we all need to keep an open mind here, because what's happening here is in many ways unprecedented. So we'll have to gauge this here during this earnings season, obviously in the next few weeks. On the S&P, I would say we're kind of at a key point here, and the pattern has to prove itself one way or the other. On the NASDAQ, I can still see it going higher. But the issue is, because these patterns are so steep, there's really no room for error. This is one of the reasons we have continued levitation, because if you break the pattern, then a technical reaction will take place. I mean, if you look at just the last couple of weeks, prices have been extremely tight, and you got to observe what's actually happening in the marketplace. What's the actual action? The action has been gap ups, and then very tight intraday price range. You see 2, 3, 4 handle price ranges, and then nothing happens. I don't like staring at dead screens, for hours on end. That's not. We like volatility, right? And so obviously this is probably one of the reasons I'm critical of what's happening with central bank intervention and buybacks and everything else, because it always compresses volatility. I mean, it did it in 2017. Did it during portions of 2018, and then at least in 2018 we had some nice snaps and we had some explosions in volatility, and that's where traders love that, right? That's where we can certainly make good directional moves in either direction. You always can assess maybe potential triggers that are out there, and then there's the ones that no one sees coming that surprise you. My general view on these things is, if the technicals line up, the market will find an excuse to validate the technicals, right? So, I mean, if you're talking about known triggers or potential known triggers, in the immediate front, it would be earnings. So far, markets have basically ignored everything on the earnings front in terms of reduced growth expectation. It's basically this replay that we've seen in 2015, 2016. We had this earnings recession. Markets dropped hard into early 2016, and then central banks intervened. This is where we saw this massive intervention of $5.5 trillion. We saw Janet Yellen pausing the rate hikes. And basically, I think the market's hope here is that we're seeing a repeat, right? Because Jay Powell is following the same script, immediately backed off of everything. And the earnings recession is going to be temporary. After all, China is again intervening, right? So we do still have this whole liquidity game in place. And I think this is the big challenge now, to say whether that program shifts. Because at the end of the day, what we saw here in 2018 is a big wall put in front of central banks. Your experiment has failed. I mean, that's what the market said to the Federal Reserve, right? This attempt to finally normalize was stop dead in its track. And I think that's the larger concern here. If you look at credit, one of the big drivers of this rally has been this move into high yield credit. I mean, it's absolutely incredible when you look at that chart. And so the entire market basically is trying to replay the game of cheap money. The Tina effect, there's no alternative, buybacks. And then, of course, you have this whole concern of people being left behind, the FOMO effect. That's why I wrote about this week about, this potential combustion effect, because everybody may feel the need for speed, forced to chase the ever-rising equity market that does not correct. That, to me, is always a very dangerous environment because it's very unpredictable in nature. I mean, we've seen this in 2000, right? These things can go absolutely wild, even though they're not rooted in any fundamental reality. And so we're finding ourselves in a really interesting point, right? Because equity markets are near all-time highs, and the economy has slowed down. So we have a gap, right? So either you're going to see some growth re-emerging, maybe through a China deal, and then there's hope that all this growth will come in the fourth quarter and basically bail everyone out. Because the reality is here, this rally is not based on fundamentals at all, right? So it's basically the hope that central banks reversing will again provide the same script as they have done for the last 10 years. And you have to ask yourself, how long can this repetitive game that disconnects equity markets from the underlying growth basis of the economy further and further and further? Here's the fascinating aspect to me. I mean, look just historically where we've come from. 2009, obviously, we had the great financial crisis, and central banks had to do what they had to do to save the financial system. Fine, totally get that. But keep in mind, originally this was supposed to be a temporary move. We were supposed to temporarily intervene, and then we will normalize at some point. And I think all of us now have to, and I don't know if central bankers are willing to admit this or not, but this is basically the reality that this has morphed into. We always intervene now. We will never stop. We can't stop because at the moment we try to be non-accommodative, everything blows up in our faces. That's exactly what we saw in 2018. Keep in mind, the Federal Reserve policy was accommodative all from 2009 all the way into the fall of 2018. Jay Powell still had accommodative language in the Fed statement, and it was only in the fall that they removed that for the first time in 10 years, and markets dropped 20%. And the economy started slowing down. I mean, you can argue, well, the markets dropped because the economy slowed down. Really? Then why are they rising now? Because the economy is slowing down. It's not that. It's the fact that yields rose in 2018. They reached a historic trend line, technical trend line, got to little over 3.2%, and that was it. This debt-laden construct that's been created over the last 30 years and exacerbated vastly in the last 10 years cannot handle higher rates. It just simply can't. And that's why they reacted. And so to me, the question is, a lot of people are now asking, well, maybe there will no longer be a cycle because central banks will always intervene. Well, I'm sorry, we were creating a spiral to Neverland, right? Because it takes ever more debt to sustain the system. In fact, this year now, I mean, just look at the US government side of it. We're exploding deficits ahead of a recession. $1.1 trillion already for 2019. We're basically double deficits in the last 2 years. 68% deficit increase in the last 12 months. Obviously, we're seeing interest rates being a major decisive factor in how you manage budgets. The US government's interest payments on debt are skyrocketing as well. And so lower rates are basically needed to sustain the system. And by the way, that's why you can justify this rally right now, because rates dropped again, the cheap money game is back in town. Central banks flipping dovish, staying dovish has worked to sustain the system. But we also have now learned an important lesson. We know where the red line in the sand is. It, again, cannot sustain higher rates. And so now for the last 30 years, we're on a process look at the Fed funds rate, lower highs, lower highs, lower highs, lower highs. And hence, it's no surprise that we now see from the political side pressure for the Fed to cut rates and to start QE again. It's certainly the way markets are reacting at the moment, right? Because a rate cut actually was high probability priced in the last few weeks for the end of the year, and the market again is reacting to that. However, historically, and this is interesting, at the end of a rate hike cycle, when the Fed starts cutting rates, it's actually a bearish sign. We saw it in 2007. They were able to raise rates to a certain amount. Then they stopped their rate hike cycle. Markets kept rallying for a while longer. They did the same thing in 2000, right? Markets kept rallying for a while longer. But then they were forced to cut rates as the economy was entering a recession. And none of this was bullish. So I think a lot what's going on right now is Pavlovian reflex behavior. This is what we've been trained to do. Feds go dovish, we buy stocks, right? This is the game. The question is basically, do we have sustainability on that front? And I somehow doubt that. Remember, 2016, the case we just mentioned earlier, it came with $5.5 trillion of central bank intervention. There is no such intervention at the moment. There's a wait and see approach on the side of the ECB, on the side of the Fed. Chinese are certainly intervening. Well, first of all, again, I'm coming to patterns and structures. One thing you see in markets reacting, you can see it virtually every day, is how price reacts to gaps. So far this year, we've had 7 open gaps on the S&P that are now completely unfilled, and we keep building them. We get now to the point where if you have a 8th or 9th unfilled gap, markets come back and they fill that, and then the algos react to that. It's a fascinating game. I mean, I'm watching it from a technical perspective. Obviously, I'm looking at larger structural trend lines, for example, but you can see it on the shorter term time frames as well. And you see where the algos are printing their paths. It's quite fascinating. On the short term time frame, you can say it intraday, basically. I hate to say it, but if markets are as compressed as they are right now, you can even look at 10, 15-minute chart. In fact, the 15-minute chart has ruled so far this year. You get an RSI oversold reading on the 15-minute chart, bang, the buying comes in. Gets overbought, negative divergence, there's some pulling back. It's a very, very tight game. For what we need to say, to see some sort of evidence of a larger pullback evolving, it starts with the basic. You see a daily 5 exponential moving average dropping and closing below. You need to drop below the 10 MA, you need to drop below the 20 MA, and then the big one for me is actually not only the 200 MA, but the 50 MA. As long as you can stay now above these larger MAs, I think bulls are fine. It's ultimately, you get a pattern break that forces price below key supporting levels and averages and fills some of these open gaps. You get this volatility explosion again. Keep in mind, it can happen fast. We saw that in February of 2018. Boom, you had within 4 or 5 days, you got 10% down. So this is the danger in compressing volatility, and you see a lot of people being net short the VIX again, right? It's this unfalsifiable belief that volatility is compressed, that central bankers control now the price liquidity equation again. My wife, by the way, she's like the swing chartist excellence. She has an eye for these larger structural patterns, and she's seen some things right now. For example, on volatility, I know there's a lot of people saying you cannot chart volatility. Yes, you can. It's quite fascinating, and we're seeing some structural patterns that lead us to believe that there's going to be a larger VIX explosion coming in 2019. The problem with these patterns is, and especially when the VIX is very low, it tends to consolidate. It can consolidate for weeks, and it can be extremely frustrating if you want to fade it. And of course, we see the monthly OPEX program as well. VIX gets crushed every time doing futures expiration each month. But watching larger structural patterns and being patient to see them evolve, and seeing all the elements come together, this is obviously where we're saying, okay, now we want to be very cautious about any longs. So for example, right now, I don't like the long side here. Made no secret about it. At the same time, I recognize the factors that are at play that say, yes, we can get this crazy blow-off move into the 100 area even. Well, first of all, I'm just looking from a pure fundamental structural basis. I find fascinating what's happening with the small caps right now. Small caps are massively in debt. Some of the highest EBITDA vis-a-vis valuation ratios completely out of sync with what we've seen before. We're also seeing an ever larger portion of small caps being non-earners. This is your classic red flag sign. Here's a market that keeps diving into an asset class that has a lot of weakness in it structurally and fundamentally. And on that note, ironically, last year in 2018, small caps were leading. But this year, they've been kind of lagging. It's been struggling with the 200-day moving average. Maybe that'll change now with earnings, but to the extent that earnings growth is actually structurally slowing, I think they'll be highly vulnerable. To me, they're still kind of a warning sign. Of course, if you see earnings all of a sudden surprise, and this is, by the way, another discussion maybe worth having, is simply because earnings estimates have been taken down so hard, most likely they're going to be easy to beat. The question is what's happening with the larger outlooks for these companies. So small caps is a area that I'm closely watching in terms of performance. The other one's Europe. I am absolutely fascinating. We talked a little bit about central banks and their influence. Here we are in 2019, and Europe is borderline recession. I mean, I know the central banks of the world are in the confidence game. They will never go out and say the recession is coming. I mean, that you would have panic, right? That's when people would sell assets. Can never, ever admit that. And keep that in mind when you watch a central bank declaration, minutes, or press conference. We see no risk of recession. That was Ben Bernanke's famous line, subprime is contained. They will not advertise that. So we're finding ourselves in a situation where the ECB had to ruthlessly take down their growth estimates for Europe for 2019, didn't see it coming, and here we are, 10 years after the financial crisis, with the ECB at negative rates. What are they going to do? The entire financial system appears to be now completely, utterly dependent of ever more stimulus and intervention. We've not seen a capital market running without intervention of some sort in the last 10 years. No new highs without dovish central bankers. No new highs with some sort of accommodative policy. Now, to me, that's a massive risk factor because we've never been here. We've never been in an environment where an entire larger economic region is on the verge of recession after 3 years of negative rates. Where do you go from here? I mean, to me, that's probably the biggest question here. We have now, for 10 years, relied on permanent intervention. And where did we end up? We end up in a situation where growth is slowing. Yet we have, like in the United States, we have 49-year lows in jobless claims, a 3.8% unemployment rate, and a Fed completely capitulated. We're too scared to raise rates. There's a gap. There's a gap in the narrative. There's a gap between the fundamentals of the economy. There's a gap between capital markets and structures and how everything is placed, and it's completely disconnected. And to me, the question is, how will this ultimately balance out and reconcile? Will we first get this massive blow-off move to the highs, to two new highs, or will we see something in the next month or two that will basically test this Q1 rally? I've posted some charts on Twitter, and it's been a massive move that is also completely uncorrected. And so, to me, again, this is the test that needs to take place. You can either assume that these charts will go vertically for the rest of the year, or you may not. I choose to believe that at some point there will be some sort of corrective test of otherwise you end up S&P, 4,500 by the end of the year. You can't maintain a pace like that. So then the question is, okay, will we have some smaller corrective moves and they will get bought? It's possible. Maybe we get the 3-5% move and the control of the system maintains itself. And maybe you get the China deal and you get this blow-off move. But the fact that you have so much liquidity jumping into chasing the same vehicle, to me is a concerning sign. From our perspective, we are trying to be swing traders, and by saying we are trying to be is that we pick our spots. We're not day traders. That's not our game. And right now, the environment, if you're in a long side, it's fine. You just keep riding the wave and you adjust your stops. Once your stops are taken, okay, then you can relook at this picture. If you're trying to fade it, you got to be very disciplined. There's no place for stubborn bears, just like there is no place for stubborn bulls. We saw that in October, right? Everybody was stubbornly projecting, 3,000 is coming, and then all of a sudden we're at 2,300. These moves can keep going. I'm interested in at least testing this, simply because of what I see on the technical side, on the extensions, on the divergences, and in the fact that this thing has not even had a basic technical correction. So you got to be disciplined in dealing with it. VIX futures is an interesting one because you can work with stops, but got to be very aware of the pivot points. What's been working, obviously, for the last 10 years is selling volatility, specifically on spikes when they come. But we've also seen the flip side of that. We had a lot of record people shorted. This product last year was called XIV, and it blew it up in everybody's face. And that's always the danger with those things, because volatility can happen overnight. And then you're trapped. This low vol game that's been permeated the landscape so long, I think is going to continue to be challenged. Keep in mind, as much as we have low volatility now, what we've seen in the last year and a half is not low volatility. In January 2018, we had a massive global blow-off top. In China, Europe, everybody peaked during that time frame. It was the US that managed to squeak out a new high after that initial correction. Remember, it took months and months and months in that tight channel. And then obviously we had that massive sell-off into December. So this rally here, and this is, I think maybe all of us are forgetting this, because we've been so accustomed to this new regime of really short-term corrections and vertical V's going back up. This rally here, 23% off the lows, that's a classic bear market behavior, right? It keeps stretching it, but there's obviously a trend line I've been following from 2009. Basically, on the logarithmic basis, it says we broke the bull market trend. And this rally here, as aggressive as it's been keeps tagging that trend line. Now you can argue, okay, well, that trend line keeps rising, so you can just keep tagging it and get to new highs. That way it's possible. But one of the things that was working again last year, and it worked in 2007, it worked in 2000, it's when you make these new highs on specific technical signals, negative divergences, weakening in participation. These kind of signals, and I just mentioned these two here, worked in 2018. I wrote that piece called Lying Highs, where I said none of this looks technically well, but no one cares, right? Because you have all this wave of optimism, you got $1 trillion valuation, everything is fantastic, stocks keep going up, keep going up. But then it happened, right? I mean, it frustrated the heck out of me too. And this is kind of where we're in the phase right now. You either blindly buy, and you ignore the signals, or you try to carefully position yourself for what the signals are actually telling you, because the signals are there. They're here again. But unlike bottoms, which are events, tops are processes. So in the overall structure, we have these massive moves. 15% up, 10% down, 10% up, 20% down, now 23% up. That's not a sign of a stable bull market. That's a sign of a lot of things going on underneath. And again, this rally here, not fundamental base, but central banks, buybacks, and political job owning. So we still have that gap of price discovery that has to realign itself somehow and hasn't done so yet.